Thank you all for joining us here for your lunch hour at the MaRS Best Practices series. So this is the second in our Valuation Series. So looking at investor interest in different spaces, looking at how investors come up with that magic number which tells you how much your company is worth. This one's in the clean tech space, which is an area of amazing growth, as you all know. We've got two speakers today to help make some sense of that. We've got Rupert Mayer joining us from National Bank Financial. So he's an energy technology research analyst and has almost 20 years of experience in this sector. He's been ranked #1 in the sector by Brendan Wood International in 2010 and has ranked as a top gun since 2008. So Rupert has a background in science as well as business, so this gives him a unique perspective in this. Rupert's going to be followed by Tim Babcock from the TSX. And the TSX is a great partnership to have for us because they bring a really, really unique perspective on investor space. Tim is a director, listed issue services, and he's responsible for managing the Ontario Listings Group, which is responsible for overseeing and ensuring the quality of new listings and transactions for the TSX Venture exchange in Ontario. So we're pleased to have them both here. They're going to speak for about half an hour on slightly different things, and then of course we'll have a Q&A period at the end, which will be really valuable for you to get some first-hand insight. So without any further ado, I'll give things over to Rupert Mayer.
Well, thank you, Joseph, and thank you, MaRS, for having me here today. It's always a pleasure to do talks like this. I find they really help me to get better perspective on my own job, to drill down and to figure out how we value clean tech stocks, because it is part art, part science, and really never an easy job, particularly with earlier stage companies. So to jump right into it, the presentation today, I'm going to look at what is clean tech. And clean tech has a pretty broad definition, means a lot of different things to different people. Look at some recent trends in what we see in our coverage universe, and then look at company valuations. I'm going to focus on two specific markets I'm quite close to. One's renewable power, and I'd say the valuation on these companies are more science. And then the transportation sector, which has some more mature companies in it, of course, but it's also seen as a high growth opportunity and a market for new technologies in vehicle electrification and alternative fuels. So a lot more earlier stage companies there, and that is definitely more of an art. And then we'll also look at some investor trends. Now, I was looking at this morning, and I looked at the title and what I'm here to talk about, which is what do investors look for in clean tech? And I think the answer is simple, and we all know the answer. It's the same as what investors look for in any investment. They want cash. So when you're looking at how to value a company and what investors are looking for, they're looking for high growth opportunities with solid business models. And I think it's a mistake to think that you're going to find investors in clean tech who are investing in clean tech to save the world. There are a few who do that, but they don't drive the valuations. Really, the investors are looking at clean tech because, as Joseph said, it's seen as a high growth space. We are going to try to save the world, and governments are going to put money into this sector. That will drive high growth and drive better investment opportunities. And I'll give you an interesting case study here. The top performing fund in Toronto in 2008 and 2009 was actually a clean tech fund. And these guys have specialty in clean tech, and they made a lot of money just as the bubble crashed. It was because they shorted the entire sector. So they're definitely, I would think they're black rather than green if you're shorting the clean tech sector. So clean tech, for me, the Canadian perspective, it is definitely a small cap universe in general, and it is resource heavy like the rest of the TSX. A number of the companies that we cover are actually green utilities that are operating wind or solar farms. And we've got great resources in this country in hydro, wind, and even solar to some degree. We don't have the same large cap equipment manufacturers that they would have in Europe or in the United States, like a First Solar, a SunPower, or a Vestas. We also cover alternative fuels, so I look at natural gas as an alternative fuel. Of course, we've got Westport Innovations in this country that's a leader in that space. Hybrid vehicles, electric vehicles, biofuels, fuel cells, hydrogen. You can find good examples of companies in all of these areas in Canada. We look at water, water treatment, water utilities, waste management. I cover ISI BFC, the largest waste management company in Canada. We'll look at anything dealing with hazardous waste or environmental remediation, and energy efficiency, another hot space. So if you look at this, it's really the entire TSX that we have to cover in Cleantech, but we're looking at the clean portion of the TSX. And it can be a challenge, and the reason we focus on these stocks at such a broad space is really to look after our clients. So my clients in Canada, you get a lot of the generalist portfolio managers, but there are some specialist portfolio managers in Cleantech in North America and in Europe, and they want all of this. They want someone who can talk to them about the trends in all throughout Cleantech, and they'll invest in this broad universe. So if I look at my coverage universe today, I've got a couple of companies here that are in solar power. 5N Plus is really a materials company. They provide cadmium telluride to First Solar, the world's biggest solar company. Carmona, that does little LED, solar-powered LEDs. A lot of independent power producers that are operating wind farms and some geothermal, some hydro. One wind equipment company, some alternative fuels, and waste management. Maybe a couple interesting things you can see from this slide. If you look at the market cap of these companies, I'll cover anything from about $18 million up to $2.8 billion. So it's a very broad space. And again, valuing the companies on that range of market caps, you're looking at very different methodologies. So we do have companies that are pre-revenue and some that are making billions of dollars of revenue. Same thing on the earnings. Some are really pre-earnings, not meaningful earnings at this point, and some quite profitable. The sectors I'm going to talk about, I'm going to talk about alternative fuels, and I actually have an underperform on 2/3 of that universe, and the renewable power sector, where I'm sort of neutral on it. And I wouldn't say that I'm going to talk about the most boring sectors I've got. It's actually because they're the most highly valued that I'm going to talk about them today. I look at those companies, and I think the valuation is run because there's so much interest in the sector. So to start out, if we look at where the interest is in Cleantech today, it's always valuable to stand back and see where the venture capital is flowing. That shows me where the next generation of technologies are coming from and where the smart money is going. So Cleantech venture capital has been on a very good increasing trend over the last decade. Last year was not great, but this year, as you can see, through Q3, we're already ahead of last year. So we are seeing a pickup in interest again. In the spaces that are most of interest, solar has always, well, the last few years, been the biggest area of interest. And I think it's because there's so many different ways to generate energy with solar, and there's so many unique angles. And a lot of the venture capital is going to California, where they've got lots of sunshine. So it seems to always be the most favorable area. Even though the opportunity in transportation and biofuels may actually be bigger in the near term. And that's really the number 2 area. I group them together because I see them really as targeting the same market. And then smart grid and energy efficiency, number 3. And the smart grid and energy efficiency today I do see as really being wrapped in with renewable energy, and I'll talk about that in a moment. So we look at renewable power quickly. I'm sure you've seen these charts. The solar market is growing very rapidly on a tear this year, probably going to slow down next year. Same thing with the wind market. It slowed down a little this year, but it should continue to grow. We're looking at compound annual growth rates of almost 50% in solar for the last decade, almost 30% for wind. Clearly, the market opportunity for renewable power is growing very rapidly. And then when you look globally at how much of our energy we get from these renewable sources, it's still really nowhere to be seen. So the growth opportunity is still large going forward for a number of years. Transportation, also a hot sector, driven primarily by the U.S. today. That's the way we see it. And the reason is, of course, that the U.S. only gets about 50% of their oil from domestic sources, and they're obsessed with energy security. So this 1/3 of their energy, their oil supply that comes from outside of North America, is what they want to eliminate. And if you look at where the oil is being used, it's primarily in gasoline for cars and diesel trucks. So that 60% of their consumption is really the target. So we're looking at targeting oil consumption in cars and trucks. Now this is very much a government-driven sector, and a lot of my time these days is spent tracking what's going on in the U.S. Senate. And of course, they can't seem to agree on anything, which means that none of the tax credits are being passed. And we're actually looking at a number of tax credits expiring at the end of this year with no visibility on when they'll be renewed. But my sense is that we will get more support for alternative fuels and vehicle efficiency from the US government next year. I find it is really interesting to note that the oil consumption in the United States last year was actually lower than it was in 1978. So it's wrong to think that we've got this continuing trend that is going to go until the end of time of oil consumption. I think there really is a great opportunity to cut oil consumption through energy efficiency and alternative fuels. And a lot of the focus of the big policymakers in the US is on energy efficiency. The EPA and the White House have managed to put through a requirement to increase vehicle efficiency by 30% by 2016. Very low-hanging fruit, of course. The US are still driving around in big SUVs and trucks and burning far more oil than they need to. But we also see the same trend coming into heavy trucks now, with a talk of increasing efficiency by 20% starting in 2014. A lot of interesting opportunities for new technology in transportation. So getting into valuation then, this is where it is really part art. That there are a number of factors that drive interest in the sector and will impact the valuation from day to day. Of course, government support or announcements of feed-in tariffs and subsidies, interest in climate change, changing price of oil will drive interest in clean tech, any global conflict, as well as technology advances. But the impacts that these factors have on companies are never really sustainable. Ultimately, it has to be the science that takes over on valuation. So if we look at how we value companies, this isn't out of a textbook. This is really out of our use and what we use at National Bank. I'd say there are two basic approaches. One, you're looking at an absolute valuation. We look at the cash flow generation from a company or the assets that the company has, and you can put a value on a company based on the value of that cash or assets. And the other is a relative valuation. How does a company compare to its peers on its price to cash flow or price to earnings, price to sales, or enterprise value to EBITDA? And typically, we'll use the relative valuation more often. The companies that are more mature and are carrying a lot of debt or have high depreciation will use an EV/EBITDA, so that's more of a technique you'd use for utility companies. Because they have high depreciation, the earnings aren't necessarily representative of their cash flows. For tech companies, earlier stage companies, price to earnings is usually a favorite. These are companies that don't have much debt, usually very little interest payments, and the earnings are a good proxy for cash flow. If the company is pre-earnings, then we'll often turn to something like a price to sales. Now, for earlier stage companies, again, getting back to art, we have a number of qualitative valuation factors we'll look at. And time again, I'll meet with a company that has a great technology and I'll think, well, there's no way this can ever fail. But of course, if you don't have the right management team, there are lots of ways it can fail. And portfolio managers and venture capitalists are always focused more on management than anything. And of course, as you're building a company, you're developing a relationship with the investment community. And you're building a trust with them. They definitely watch the company's track record. They definitely watch what the management says they're going to do and watch how they deliver on expectations. So I'd say if there's one thing you can take away from this, is when you're dealing with any investor, is definitely to set your expectations beyond your capabilities, and to be upfront and to communicate with them well and build that good relationship. Growth potential, of course, visibility on growth is important, profitability, sustainability of the business model, but it can be really hard to nail some of these things down with earlier stage companies. So I look at valuations today across subsectors. I've got a number of sectors here where I'm looking at the gross margin, operating margin, and growth, and as far as percentage goes, in solar materials, solar cells, wind equipment, independent power producers, biofuels. We have a range of different business models here and different growth rates, but in the end, the price to earnings ratio of the company is always kind of fall in the same range, about 10 to 15 times. And I think if you look at the TSX on the whole, stocks are trading at about a 14 to 15 times price to earnings ratio. So that's about where these companies should be. A couple of sectors that stand out are the ones I'm going to talk a little more about, the independent power producers. And they have a high price to earnings because they have a much higher cash flow than the earnings would suggest because of the high depreciation they have. And then there's the transportation sector, alternative fuels, which has the higher growth. But I look at the independent power producers. Again, it is a bit of a science. We can track how these companies trade over time as far as their enterprise value to EBITDA goes. And today, they're actually not that cheap. And I think you'll find the same thing across the TSX. Although we've come through a very difficult time on the markets, stocks aren't cheap today. They're trading pretty close to fair value, and in some cases, multiples are a little bit high. If I look at the range of companies I have here, they are some foreign, some Canadian. They're trading at typically a fairly broad range of EV/EBITDAs, but not too far off the mean. And investors like these companies because they have fantastic visibility on cash flow. A number of these companies actually pay dividends, and that's something investors like to see today. Now, the sector still does have good growth. You're probably mostly aware, most of you will be aware that we have very aggressive feed-in tariff proposals here in Ontario and in other provinces, that companies are signing long-term contracts at fixed rates for power with solar and wind power. The equipment gets a 50% depreciation, which is of interest for utilities. It's a huge investment opportunity. So we do see good growth potential here. There's also great consolidation in the sector. A couple of the companies that I cover have been purchased in the last year. And the reason is that the large utilities are hungry for growth. They're hungry for that depreciation. And they're hungry for the visibility on the cash flow. So they're purchasing all of the smaller independent power producers. The Canadian Hydro Developers was bought last year, KHD. Wasn't a very small company at the time. It went for more than $1 billion. Pristine Power, another one I cover, is being purchased now. Now this slide here, I have the feed-in tariff rates for Ontario. I'm actually looking to have solar panels put on my own roof because of the feed-in tariff for solar on the rooftops, you may know, is 80 cents a kilowatt hour. It's probably the most aggressive feed-in tariff in the world today. So we'll see good growth in solar in Ontario and in wind. The wind feed-in tariff is $135 a megawatt hour. The question is, how long can this last? And I'm becoming a little more negative on what's going to happen in the Canadian renewable space. There are a number of risks to this space, like permitting projects, increasing competition. It is difficult for early stage companies to find capital here. But we are also seeing that power markets in North America are in oversupply. And here I have two charts. One is the power price in Ontario, and the other is the demand for power in Ontario. This top line is the 6 years from 2002 to 2008 on the power price. So it's really between $50 and $60 a megawatt hour. And then in 2009, the market collapsed and power prices dropped quite a bit. And in 2010, it looked like we're getting a recovery, but power prices are on their way back down again, meaning we have an oversupply of power. And you can see that demand for power similarly is quite low. So we're in a market here in Ontario where we're building plenty of wind and solar while we close coal plants, and we're going to need to back that up with more natural gas-fired generation. But we really actually have a surplus of power at this point. And power prices, these are wholesale prices, but the power prices to consumers are on the rise because of the high cost of renewable energy. So are there other opportunities? Well, if I look at Ontario, we had a talk from the Chief Operating Officer of the IESO, the guy who controls the grid in Ontario, and he put up this chart, which is, he called his spaghetti diagram. It takes a little bit of explaining, but this is looking at every single day in December of last year in Ontario from 1 in the morning up to midnight, and you take every day and you look at how much power was generated by all the wind in the province that day. So on this day, the wind sort of sat around 900 megawatts. What concerns the grid operator is that you have days like this one, this light blue line, where the wind can start high and then go all the way to zero across the whole province, even though we've got wind farms from Wolf Island all the way up to Thunder Bay. And conversely, you can have days where you can find the wind goes from nothing to full power. That's okay when you've only got 1,000 megawatts, but right now we have visibility on 6,000 megawatts in this province in a few years. So the grid operator, will typically see power demand go from maybe 12,000 up to 20,000 megawatts during the day, is now going to have to try to balance that grid while either having this supply shock of gaining supply or losing supply. It's going to become unmanageable. So we'll see a number of opportunities, maybe first here in Ontario, where demand-side management technology is going to start to become interesting. Energy storage technology, time of use meters or controls in the homes if we start to see more time of use signals in our power markets. But this could also slow down the growth of the renewable power sector unless we have these other technologies to help enable. So transportation, it's another interesting sector. I've got a range of different companies I put in my comparables here, from companies like Caterpillar and Cummins that of course are well established, to some mid-size companies dealing with natural gas, fuel system solutions, Landy Renzo. Electrovaya is a company here in Ontario you may know that's looking to sell lithium-ion batteries into the vehicle market. And then Westport Innovations and Azure Dynamics, natural gas and hybrid companies. Look at the growth rates on these companies. These are analyst assumptions, and analysts aren't always right. Take it, I know that for a fact. The Azure is growing at 170% per year, roughly. Clean energy and Westport and natural gas fuels at 50%. So investors are paying high price to earnings multiples because they can see the growth coming here. So it is part art. I think more often than not, analysts are wrong, and the growth can be higher, can be lower, usually lower. But anyway, it's driving great interest in the sector. But as I mentioned before, I think we do see long-term growth potential here. We expect the governments, and particularly in the US, to put more money towards energy efficiency in transportation as well as alternative fuels. So that's an opportunity for natural gas. It's an opportunity for batteries and electrification systems, for biofuels, as well as lightweight materials or anything like that. This chart here is just looking at the spread between the price of natural gas fuel and diesel in California, which is a key market for natural gas vehicles. The sense that people have today is that oil is very expensive and natural gas is very cheap. But in fact, the price at the pump is about on its 5-year average. But nonetheless, with the excess supply of natural gas that's been discovered in North America recently, there's great interest in using it in transportation, but even more so in power. And actually, that's one thing I could have mentioned before, looking at the wind market in Ontario. The government expects that every megawatt of wind power that gets put into Ontario will need a megawatt of natural gas-fired generation to back it up, to deal with the intermittency of the power. So looking at a few financing trends here, I borrowed this chart from SDTC. Thank you, Susan. You've probably seen this before, the pre-commercial gap, the trouble that companies have in taking their technology from research through to the market. Now, this is well before what I deal with, of course. I'm typically dealing with the public companies and here with the banks. The venture capital market today, from what we have seen, is a little more cautious than it has been in the past. There is money available. We saw that from one of my earlier slides. But I think that the markets in general are more cautious. And we have seen a number of public company investors that have been willing to put money into private investments in the past, and they're becoming a little more nervous as well. But there's still opportunities for good companies. And I'd say a couple more things that investors would like to see before investing in an early stage company. They want to see not just a solid management, but management that has the skin in the game, that management that is fully invested in the company and really not able to walk away, so that it keeps them up at night thinking about how they're going to make this company work. Also, companies that are on tight budgets or bootstrapping. No joke, I had this one company I was covering that it was pre-revenue, and they raised some early stage private money and they bought themselves a corporate jet. It didn't go over well with the investors. It's always important to have visibility on the market potential for the company. And this is another interesting one. We do a lot with European investors. And the European investment community, as I'll show you in a minute, have great interest in clean tech and a lot of dedicated money for clean tech. But they can be nervous about investing in a Canadian company because it's too far away. Investors in early stage companies want to be involved. They want to be close to the company so they can help it to prosper, but also to see problems before they develop into big problems. So they always want to see that you have a lead investor who's going to be heavily involved and close to you. And as I'm sure most of you are aware, there are a number of venture capitalists who are focused in clean tech in Canada. And they all seem to have a fairly good cash flow these days. So even though I think early stage companies need to work primarily with venture capitalists, it is always important to get out and to meet the people in the public markets. And I see it as a bit of a two-way street. I like to meet early stage companies so I can see what's happening in the marketplace and what the next generation of public companies is going to be. But it can also help the company because a number of investors on the street like to have that relationship with management. They want to have that trust in the management. And it's a sort of relationship you can only develop over a year or even years. So I think it's a good idea to get out and tell your story to anyone who will listen in the public markets and start developing that relationship of trust. It's always a good idea to go back often as well and to give updates and to let people know where you are versus your milestones. And key thing, again, is never to overpromise or hype the opportunity. And remember what I mentioned at the beginning, I don't think any of these guys are investing in this because you're going to save the world. So they don't want to know about necessarily how you're going to save the world, but how you're going to make them money. So there still is a global interest in socially responsible investments. We at National Bank, and as all the banks would, we market to companies around, investment companies around North America, but also in Europe. Switzerland always has a great interest in investing in clean tech at all stages. Probably find more early stage investments in Zurich and Geneva than elsewhere with funds like SAM or Pictet. London's also very good, a number of large funds there that will invest in earlier stage clean tech companies. So it is a global opportunity, but I'd say the earlier you are in your development, the harder it is to find funds that are overseas. And we do find also that because the clean tech universe is small, that you typically get more attention overseas than you would if you were in a different sector based on your size. Because the size of clean tech, the market really is quite limited. There are dedicated funds for this sector, and the universe has been actually shrinking of late. If I take into account the companies I mentioned that got acquired, like Canadian hydro developer, Xantrex, Pristine Power, the Intergex had a consolidation as well of two of its entities. And of course, we've had a decline on the market of a number of clean tech companies like ISE that went bankrupt recently, or Taminco that lost a couple of $1 billion in market cap, or these three companies that are now delisted. So I think the market is receptive to new good stories simply because of that scarcity value. So in summary, looking at clean tech in Canada, it's definitely a smaller market cap exchange than you'd find elsewhere, which can be positive, of course, for early stage companies. We're going to hear about the TSX next, but it really is a global leader in listing of small cap stocks. In Canada, a lot of the opportunity is in resources, although there are some opportunities, of course, for tech companies. I don't think they have to leave Canada. And looking then at how investors value companies, I think ideally they want to value you based only on your cash, and with the renewable power utilities, that's pretty easy to do. Transportation sector we see as probably the greatest opportunity in the next couple of years. A big market with lots of change and opportunity for new technologies. And the dedicated capital can be found in clean tech. I think you'll find that the markets are more conservative today, but the funds are there. And it's been a very difficult time the last couple of years for early stage companies to raise money. And for the market to return, I think we need to see the valuations of the rest of the market start to get a little overheated. And I'm starting to see that now. I don't think there are really that many cheap stocks left of any market cap size. And when investors can't find growth in the large cap stocks, they start hunting for smaller investments. So I'm confident that the opportunity will return. It is going to be improving over the next year. And that's it. I think we're waiting till the end. Is that right, Joseph? No.
All right, great. Thanks, thanks, Rupert, and thanks for everybody for coming out today. So, Rupert set the stage very, very, very nicely. I'm going to talk a little bit more on the public markets in Canada, and obviously, particularly how clean tech plays into that picture these days. I'll skip my disclaimer. So what I'm going to cover first a little bit on the on our market, what our business is, what we do. Focus a little bit more on the clean technology sector within the public space in Canada. And then I'm going to talk a little bit about the kind of why and how of going public and some structures that you may be interested in. And then I've got a couple of case studies if time permits. So who are we? I'm sure everybody is somewhat familiar with TSX, but TMX Group, which is our parent company, which is a public company listed on the Toronto Stock Exchange, we operate a number of different businesses, from derivatives. We've got a natural gas exchange out west. Obviously, we sell a lot of data. We're in the fixed income space, but obviously best known for our equities business, which includes our two stock exchanges, Toronto Stock Exchange and TSX Venture Exchange. I think everybody here is probably familiar with the fundamentals in Canada. We've got a pretty solid economy here on a global sense. And what that means for us is not only attracting international companies to Canada, but attracting international investment. And that's good for anybody trying to raise money for an early stage company in Canada. So if we look, this little comparison of how our markets stack up against other markets globally, the thing that probably jumps out to everybody right away is the number of listed companies. We've got over 3,600 listed across both markets, which is actually second in the world in terms of all exchange groups. But if you look, obviously, at the quoted market value, we're substantially lower. And what that means is, and Rupert has noticed this, is it's very much a small cap space. The venture exchange in particular, obviously, is we list early stage companies. We list very small companies, not yet at commercialization. We give them an opportunity to access the public markets to grow their business. And you can see by the amount of equity capital raised, this is year-to-date September 2010, 32 billion raised across both markets, which is quite substantial when you really think about the size of Canada's economy versus other markets. And that speaks again to attracting investment from all over the world. So where do our issuers lie in terms of industry? No surprise that our biggest group is in mining. We've got a tremendous strength in Canada in mining and oil and gas as well. But if you look at some of the other categories, and obviously we're here to talk about clean tech, so clean technology, percentage of our issuers is fairly small, but the number is actually fairly substantial. We have 128 clean technology companies listed across both exchanges. And that's actually number one in the world in terms of number of listed clean technology companies. So if we look at financing activity on both markets, last year obviously we had a record year in terms of financing, but that was driven by the senior exchange. It was driven in part by some significant debt restructurings and so on. If you look just at the venture bit, so the green portion of the bar there, over the last couple of years, obviously the capital raises were a little bit soft, and Rupert has talked about how it's been a little bit more difficult these days to raise money for early stage companies. But in 2010, we have seen more money flowing back into the market. You can see that for the first 3 quarters of this year, we've surpassed the total for both 2008 and 2009 already. Take a look a little bit at how our two exchanges are set up. On the one hand, we obviously have the venture exchange, which is geared for smaller companies. It's the intention there is to provide a marketplace for early stage companies to access the public capital. And then on the other hand, we have the Toronto Stock Exchange, which is a senior market, well-established businesses, globally recognizable. It affords companies access to larger international institutional investors and so on. But one of the key things that we focus on the venture exchange, and we take a lot of pride in, is the mentorship of our issuers. Like, we're not just there to provide a marketplace for investors and companies to come together. Obviously, it's the key role, but we also do what we can to help those companies develop into bigger public companies, but also to develop that expertise to be a public company. So when you become public, your primary objective is still your business plan. You want to grow that business, but now you have this new role and you have to deal with all of your shareholders and so on. So we're there to add a little bit of support to the new management teams that may not be familiar with the public markets to help grow that business. And of course, what we intend to do is help the issuers grow and eventually graduate onto a senior exchange like the Toronto Stock Exchange. And one of the stats that we pay a lot of attention to, and we like to talk about, is a number of graduates from venture to Toronto Stock Exchange. You can see just some stats over the last few years. We have a lot of flow of venture companies growing up, so to speak, and moving on the Toronto Stock Exchange, and that's it's actually interesting. I was looking at the MaRS mission statement the other day, and I think one of the comments they have is they judge their success by how the companies fare when they go out the door, and that's really kind of our perspective as well on the venture exchange. Is the more companies that we see leave to go to a senior market, the better job we're doing. In terms of market cap across the two exchanges, you can see here, obviously on the venture exchange, we have the vast majority is small market cap, under 50 million. And then on the Toronto Stock Exchange, it's much more widely distributed, and there's some very big market cap companies on the Toronto Stock Exchange. And on the right here, you can see again just an indication of the number of companies that have moved from venture to Toronto Stock Exchange over the years, almost 500 in the last 10 years. So when we go out and we talk about the Canadian capital markets, and in particular, obviously, the Toronto Stock Exchange and TSX Venture, we talk about the strengths of this market. The first two are fairly obvious, mining and energy and oil and gas. But we also have been talking over the last number of years about clean technology. I mentioned earlier that we've got 128 companies listed across both exchanges. That's number one in the world in terms of number of public issuers. And so far this year, those issuers have raised over $1 billion. So the financing for venture companies is still tough. Obviously, you've got to be kind of in the right space and have the right story, but the money is there. So that's my quick overview of the two markets. Now I'm going to talk a little bit more about the clean technology space. So this again is looking at both venture and TSX, combined market cap of all those 128 issuers, about 17 billion. We've had 8 new listings this year in the clean technology space, raised about $1.1 billion. And on the bottom there, the 30% of the Toronto Stock Exchange issuers in the clean tech space have been graduates from the venture exchange. So obviously, in this particular sector, we also have a strong development of venture companies moving on to the senior exchange. And in terms of distribution across the various subsectors within clean technology, Rupert talked a little bit about classification of clean tech companies. We've got these 5 kind of categories here. Obviously, one of the hot spaces right now is the renewable energy production and distribution. But in terms of the actual number of issuers, it's a fairly even distribution across the various subsectors. So if we look at that $1 billion raised so far this year, where did that money go? No real surprise that renewable energy has eaten up the vast majority of that. Some of the big raises so far this year, I think Biox raised a little over $1 million in a secondary offering. They're a power producer. Interjects Renewable Energy, I think this is a company that you cover, Rupert. I think they had a couple of raises of close to $80 million each, so they've raised about $160 million this year. So obviously those are significant financings that are happening on our market. It takes a lot of different players to contribute to a strong public market, and clean tech is no different. Obviously, we've attracted a large number of clean tech issuers, but that wouldn't be possible without the support of the investment banking and trading community. You can see on the left there that across all the various market caps, we do have strong analyst support for our issuers. And the amount of trading has gone up dramatically over the last few years. One interesting bit to note too, if we look at that 2009 trading volume, that's just for TMX exchanges, so just Toronto Stock Exchange, TSX Venture. As many of you may know, we have a number of ATSs that operate in Canada now that trade our issuers on their marketplace. So there's significantly more volume than is accounted for here. And we do a couple of things that we hope promote the sector and by extension promote our issuers. One of them is the TSX Venture 50 that we publish on an annual basis. And this is basically, it's a kind of top 50 performers on the venture exchange for every year. Or I guess more accurately, it's the top 10 in 5 different sectors. And one of the sectors we do profile is clean technology. So you can see here the top 10 from 2009. This list comes out in about kind of February, March. And the stats on average of those companies. So tremendous growth over 2009, which was definitely still a tough year in terms of the economic climate. But there are some very good performers out there. So the Venture 50 for 2010, which obviously will include a new list of clean tech issuers, I expect will be out in February, March of the new year. Another thing that we've put in place is a Cleantech Index. So this was launched in March 2010, and gives the marketplace some visibility on the performance of this particular sector. Obviously, we have a number of sector-specific indices, whether it be mining or oil and gas and so on, and Cleantech is one of them. Since its launch in March 2010, I think the index is up about 5%. Which is a pretty good showing. It's been rebalanced once. I think we lost one issuer to an M&A transaction, but added 4 new ones. And it's really just an attempt to bring some additional visibility and attraction to this space. So that's what's happening in clean tech on TSX and Venture. Now I'm just going to talk a little bit about the actual going public process and some of the things that you might consider if you're looking to the public markets to access capital. So why would one choose to go public in the first place? Obviously, the first one, access to capital and future financing opportunities. Not only are you looking to raise money at the time of going public, but future financings as well. Once you're a public company, obviously to go back to market is much easier. Facilitate growth, not only can you raise money to facilitate growth, but you've got this new currency in your hand, which is your shares that you can use for acquisitions and so on. Increased visibility and prestige. Being a public company may open up doors in terms of winning contracts or negotiating agreements with other companies. Provide liquidity for your early stage shareholders, something that may be very important. And attracting talent, having the ability to offer incentive stock options may be a useful tool in terms of attracting employees. Now, how do companies go public on our exchanges? Number of different routes. Obviously, the first one that comes to mind is the IPO or initial public offering. But there's also a couple of other different ways. RTO or reverse takeover. Essentially, a private business merges with a public shell company. We could have a dual or interlisting of an existing public company on another market. And then the one that I want to focus a little bit more closely on is the CPC QT route. The capital pool company, this is a unique product, if you will, that we have on the venture exchange, and we've had for the last 25 years or so. It's been tremendously successful in terms of providing a vehicle for private companies to go public. In fact, it's the #1 route for new listings on the venture exchange. So I'm going to talk a little bit more detail on that. You can see on the left-hand side kind of what this looks like. The CPC itself, all it is a public shell company, but it's a brand new public shell company. So It's a newly formed entity with cash, a solid management team, and nothing else. And their whole mandate is to go out and find a good-looking private business to bring into that public company. And the qualifying transaction is essentially when that public shell and the private business come together as one, which in practically all cases also includes a concurrent financing. So if you're the private company, you may be looking at an IPO. IPO can be longer. You've got to attract a wide group of investors. You got to sell to at least 200 public shareholders. The CPC can provide that initial public face. It can provide the shareholder distribution, and you may be able to raise money from a handful of people to support that company going forward. So it's definitely a useful tool. You see some of the stats here. Since inception, we've had over 2,000 listed. Over 80% have completed their qualifying transaction. We've got 332 venture grads now trading on Toronto Stock Exchange, and 96 of those started their life as a CPC, which is pretty interesting because you look at the whole universe of Toronto Stock Exchange listed companies, there's about 1,400. So about over 20% of those are graduates from the venture exchange, and about 7-8% of those actually were CPCs to begin their life. So this is something that has been very good for our market. Some of the benefits, I talked about a couple of these already, but the CPC, it raises cash on its initial public offering, so it's going to have some cash in the bank. The directors that start up a CPC, typically they have some good public company experience, they have some good expertise, and for a private company looking to build a board for going public, that can be of benefit to have some of those individuals. It has the shareholder distribution already, and the listing process can be faster and less costly than an IPO. Typically, it gives the parties a little bit more flexibility and control over the process. So if we look at the start to finish of a CPC and qualifying transaction, this is kind of what it looks like. A lot of detail here, but really there's kind of two key things that happen. One is the formation of the CPC itself, and that's the left-hand side of this timeline, and then is the qualifying transaction where the private business and the CPC come together. So I'm going to talk a little bit more about this, but focusing really on the qualifying transaction. So there's 4 key milestones here. In putting the CPC together, first of all, you've got a group of founders that come together. They incorporate a company and put some seed money into it. The next step is that CPC does a small retail IPO. They raise money through an initial public offering, and they start trading on our market. Their next mandate is to go out and find a good private company to vend in. And that's what we're going to look at. So this target business operating company is identified. There's going to be a disclosure document that talks about what this private business is, and then the two entities merge and trade as a normal venture listed company after that. And then we look a little bit about what happens next. How do you operate as a public company? So these are the kind of steps in terms of the qualifying transaction. You identify that target company, announce the deal, file your disclosure document, and close a transaction. From a CPC perspective, what might they be looking at in a QT candidate or a private company that they want to do a deal with? And these are, these types of considerations go across any type of listing route. If you're a private company looking to go public, this is kind of what the market is going to be looking for, a significant growth opportunity. Particularly as an early stage company, there's a lot of risk associated with that investment. So in order to attract investors, you have to be able to put out a big growth opportunity for them to be able to swallow that risk. Strong management team, this certainly can't be overstated, and Rupert talked about it as well. Particularly for early stage companies, you got to have a really strong management team. Capital needs that can be financed. We on the venture exchange, we see financings anywhere from $100,000 to $100 million. But typically the go public financing round, generally most of them fall within the kind of $2 to $10 million range on our market. So that's kind of where you'd be looking at if you're looking at the venture exchange. Business close to or at commercialization. Obviously, would be able to meet our minimum listing requirements is key. You've got a strong market appetite. You've got some investor interest there, and you can raise enough money to carry you through kind of 12 to 18 months of your business plan. So some success factors to think about, and again, this kind of flows across any type of going public transaction. Lots of cash on closing. You want to be well capitalized. There's going to be bumps along the road in terms of executing that business plan, and you don't want to be falling short of cash right off the bat. Market interest and understanding in what you're trying to do. If you're going to attract investors, they need to be able to understand what you're doing, and obviously, next step, of course, is to be interested in it. Delivering on in the short term. So if you're going public and telling your investors that we're going to build this or we're going to discover that, then you better be able to follow that up. And a reasonable valuation. Rupert talked in detail about how an entity may be valued, but really it's going to come down, at this stage, it's going to come down to negotiation. You've got your private business, you think it's worth X. You're going to try and do a deal with a CPC, they think it's worth Y, and you've got new investors coming in that may have a whole different idea of what the valuation is. So you need to understand that there's got to be some flexibility there. The key is to come up with a reasonable valuation, not the max. As a private business owner, going public is not a sale of your business. Really what you're doing is you're attracting a bunch of new partners. So you want to have some upside for those partners. You want to have some upside for yourself going forward. Some of the potential pitfalls, obviously not being able to meet the listing requirements and not having enough cash, those are very key. And then there's some technical exchange issues in terms of the timing on background searches and being able to fit within our escrow regime and so on. So now you've completed your qualifying transaction, you're a public company. Now what? Well, it's somewhat back to business in terms of operating your business plan. But now you have a whole new aspect to deal with, and that's communicating with this brand new group of stakeholders that you have, being your public shareholders, maybe some new board members, and so on. So the key things to think about in terms of being a public company and being able to manage that effectively is communication. It's really being able to communicate with your shareholders, and that speaks to the press release clarity and quality, and the timely disclosure against milestones. No communication is worse than bad communication. If you tell your shareholders that it's going to take 5 months to do this and it takes 6, well, let them know, because public shareholders can be very finicky, and if they don't have news, then maybe they just hit that sell order. So operating as a public company, it's all about communication. That's why a good investor relations program is really key. So we've talked about the public markets, talked about listing, and obviously the question on everybody's mind is, well, how much is this going to cost? So we'll take a little bit of a look at that, just starting with the exchange fees solely. And if you look at our two markets, the initial listing fees on the left-hand side obviously compares well with other markets around the world. The max on the TSX is 200 grand, and the max on Venture is 40 grand. Basically, these are based on market cap at the time of listing. And then you also have annual sustaining fees to stay listed on the market. The two exchanges are fairly similar there, and again, it's based on market cap at year end. But obviously, the exchange fees is only one part of the equation. We've got some estimated ranges here. The cost of going public for any company can vary quite dramatically from one issuer to the next. But these are the types of things you've got to take into consideration. Obviously, you've got your listing fees to think about. The accounting and auditing fees can be quite substantial, and the legal fees can be quite substantial. If you've got kind of your house in order beforehand, if you've got some good internal expertise in terms of being able to handle some of the accounting duties, then that can be a big boon. And then there's there's many other places where you might be writing checks, the securities commissions, printing costs, and so on. So I don't know if we have any time. I'll maybe just give you a quick look at a couple of case studies. A couple of issuers that have done well on our markets. Biox, specialty proteins. This company started as a CPC. It did its qualifying transaction to vend in this tech business. And it was number one on our Venture 50 Cleantech list last year. It has since graduated to Toronto Stock Exchange. And you can see over its life, it's done multiple financings. So at the time of the qualifying transaction, it didn't need to raise any money, but subsequently 11 million in 2008, another 3.5 million in July of that year, 5.3 million in May of 2009, and then another couple of raises in December of last year, and then March of this year, another $17 million raised. And this is not uncommon for any company listed on our market. Particularly venture companies in that growth stage will go back to the market many times doing multiple rounds of financing. Another interesting one, and Rupert is obviously familiar with this, Catch the Wind. This is another company. This is Catch the Wind is on venture still. It did start its life as a CPC as well, so you can see some popularity of that vehicle. And then it has also gone back to market on a number of occasions. 15 million raised in 2008, 21 million in 2009, and 5 million in April of this year. And I think that's it for me.
Yes.
Yep.
I have a question regarding the low impact materials sector that you mentioned in the pie. Is that includes bioplastics? And the question also goes to Robert. I didn't see that portion in your presentation as a clean tech. I'm not sure if it's merged somehow in other sectors, and what is the use on that?
I would say it definitely does count. You're looking at using a renewable material to offset plastic or oil consumption. Investors would definitely consider that clean tech. When I said at the beginning, the number of sectors are broad, and in fact, clean tech is the entire TSX, just looking at clean portions of the TSX. There are a number of sectors that I haven't included simply because I don't have great visibility into those companies myself, or we don't have representation from those companies. But the selection of sectors that we cover will change over time. We'll see new sectors rising, others falling. So yeah, I think it's definitely considered clean tech.
Yeah, and I think same with our view. It's kind of a fuzzy line as to what issuers are and are not clean tech. So I think that would definitely fall into one of our categories. But like Rupert says, there's many different angles you could look at.
I have a question for Rupert regarding the chart that had the multiples for the various clean tech categories, biofuels, wind, and so on. And the wind was the highest, along with
the transportation sector.
Well, it was alternative fuels or transportation. I couldn't
Right.
understand. Well, one, I'd like to know, why is wind power the highest? Yeah, that's the one.
Yep.
And the one to the right there, I think you called it alternative fuels, but then you synonymously referred to it as transportation.
Right.
There are other categories underneath there that are hydrogen and biofuels and so on. And so I'm wondering how you're, like, biofuels, hydrogen, and then the one on the right is alternative fuels. Like,
Right.
aren't biofuels and hydrogen alternative fuels?
Yes, yeah, fair enough.
And so how are you distinguishing, like, that's your highest multiple there, so what is that?
That was primarily the alternative fuels companies that I'm covering, so I'm not actually covering biofuels. But I'm with you. I think we could put those two sectors together without any trouble.
If you put those two together, you get a really low one, right? So why is that one high?
That one's high because it includes natural gas fueling companies as well as vehicle electrification, hybridization, and batteries. And those are the areas that are the ones that are in most demand on the public markets right now. Biofuels are, I think, still having a bit of a tough time. The market for biofuels, of course, has had subsidies, and in some cases the subsidies have expired, and other subsidies are going to expire at the end of this year. So again, I think you can slice this in a number of different ways. It just so happens to be the way I've sliced it. And the wind power is high because if you remember what I mentioned at the beginning, that investors want cash. So a price to earnings multiple can be representative of cash flow, but it isn't always. The companies that have very high depreciation, typically your earnings are not representative of cash. You're actually getting back a significant portion of cash that represents your depreciation. So these companies are trading on a high PDE, but we don't value them on PDE. We value them on enterprise value to EBITDA. So in other words, the enterprise value is the value of the market cap of the company plus the debt, and they're also very highly levered. And the cash flow is the earnings before interest, taxes, and depreciation. It's a very popular sector, though, because these companies do typically pay out fairly high yields, and investors want to be as close to the cash as they can be today, so they like yield.
All right, thank you.
You produce a report on those subsidies that might fall off?
We do write about them from time to time, yes.
And where would we find that?
Well, typically, we can send research out at our discretion, but it is typically considered to be proprietary, so it's only sent to clients on a normal course of business, or it's available on our website for clients. But I can send you anything that you'd like. If send me an email.
Those subsidies you're referring to mainly agriculture ones?
There have been subsidies in the U.S. for alternative fuels, meaning biodiesel, ethanol, and LNG or natural gas. They've also had subsidies for alternative fuels vehicles. The biodiesel credit expired last year, as did the natural gas and LNG fuel, December 31st. I believe ethanol expires this year, along with the alternative fuel vehicle tax credits. But we could see them renewed before the end of the year. The Senate has a number of things they need to look after before the end of the year, and tax credit renewal is one of the high priority items.
Yep.
You talked a lot about visibility and that it's important in valuing your companies and generating investment. What would you define, what do you look for in visibility? Like, what's a good visible company?
So when we look at valuation of companies, the investors don't like to go out more than a couple of years, because they figure anything can happen in more than 2 years. Technologies can change, new competition can arise. So I would say visibility is demonstrating what you can do as far as revenue and earnings go in that 2-year time frame. And the shorter the time frame, the better. If you can do it in 1 year, even better. Early stage companies, you'll often see them valued on a 1-year and a 2-year basis. And then they'll come up with a formula somewhere in the middle, perhaps. So how do you get good visibility on revenues? Well, you can have a partner, for example, a very credible partner that has said, I plan to, whatever, if it's a car, for example, and you're a battery company, the car company says, I'm going to put 30,000 vehicles on the road next year. That gives you great visibility on your revenues. And then the remaining part of that is just proving out the business model, demonstrating your costs versus your price in the market and your overheads. It can be relatively easy. I suppose the challenge with earlier stage companies is that the growth is usually much longer term than 2 years. It can be 5, 10 years more. And unfortunately, as I think we were hearing earlier, the market won't always pay you for that time frame. They're more likely going to pay you for the 2-year time frame. So you may feel like you're selling out at a low price, but that is somewhat the reality of I think, the investment world. And so you would like to take as little dilution in the early days, as little as possible, and try to get by on as little capital until you feel your business is valued appropriately.
Would that explain some of the going back to the market repeatedly that we see?
Exactly, yeah.
How much of your company should you put public in value? Is there any rule for that? Like your company
In terms of how much you would want to maintain after being public?
Split that up into what you own and what they're offering to the public. Is there any rule in the new company?
Well, there are some listing requirements around that. In particular on the venture exchange, at least 20% of the company has to be held by the public shareholders. But really, that it all comes down to that negotiated valuation. So, how much money do you need to raise from the public? At what price do they want to put money into your company? And from that is obviously going to flow how much of the company that they're interested in. So it really comes down to that negotiated valuation.
And it is a bit of a double-edged sword. I think investors often like to see the management has a big piece of a company.
Mm-hmm.
They want to know that you're invested in the company. But at the same time, if management has too much control, then they can have their way over and above their investors, including, for example, preventing the takeover of a company, which can be profitable for investors. So I'd say that ultimately investors like to see that management is invested. That's very important. Maybe in an ultimate structure, you'd want to see management invested up to maybe 30%, but not too much more.
Yeah, it comes down, and like Rupert said, it comes down to skin in the game. You want that management team to be on the the same line as all the other shareholders, but there can be too much.
I've heard that question a number of times from portfolio managers. They'll look at a company and they'll say, how much does the CEO own? And if he owns nothing, they won't touch it. And stock options don't count.
And even from the exchange's perspective, if we're looking at a new listing applicant and the management team doesn't own anything, then that raises some flags with us as well. Yep.
I think in your multiples across subsector category, you might consider adding energy storage technologies. You mentioned it once, and you put up a slide from the ISO. There's a whole variety of reasons why intermittent renewable energy can be improved in terms of its value to the grid. Some of that is through better forecasting, better modeling, better geographical siting, and so forth. I don't agree necessarily with the one-to-one backup of gas to wind that you were citing in your presentation, but coming back to energy storage, that's the real sweet spot in terms of enhancing the value long term. So the whole range of technologies that are growing, sodium sulfur batteries, flywheels, companies like Beacon Power, for example, in the U.S., getting enabling legislative framework to enable, in other words, getting tariffs and wholesale power pools for their technology. Other technologies like superconductors, compressed air, energy storage, which will ultimately allow for the base loading and dispatching of wind in real time. All of these things are going to happen in the next, several years. And so it might be something that you want to consider. There's a number of companies that are already in these markets.
I agree. Yeah, I worked in that market for a number of years. And to some degree, we capture it in the hydrogen fuel cell business. Hydrogen is an energy storage medium. And battery companies today, we have largely lumped into the transportation sector, seeing that as maybe a more near-term focus to the investment community. But no, I'm with you. I think it definitely could be a sub-segment of its own.
Anybody else? Yeah, where are you most optimistic in the biofuel arena?
That's a good question. I'm doing some work in the area right now. I think it's tricky. There are so many different technologies out there, so many different ways to make fuel. I think ethanol will continue to do well in the United States because of the farm lobby, without a question. And biodiesel, there are companies like Biox here in Canada that are using renewable fats, so basically waste fats, to make biodiesel. I think that makes sense, but maybe has a limited opportunity based on feedstock availability. Of course, there are a number of different enzymatic technologies out there, gasification technologies. There's so many ways to make biofuels. It's tricky, and I'm not a technical expert in any one of those areas, but I do see multiple opportunities today. There seems to be a lot of interesting developments in waste to energy as well. No, I couldn't say. What I've seen, though, there seems to be a lot more activity in gasification these days. It's more visible than what I'm seeing in the enzymatic areas.
Can I just share about the because
Yeah, please do, if anyone.
biofuel things. In fact, well, we are a company, we're a startup company. We're working on a biodiesel site, but it's coming from a plant that you can't eat. That's completely food. But the problem is that you can't grow that in Canada, but you can grow in the like in the tropical developing countries. Some of the American companies are already into it, and that's like basically it's a trees, and then you just get the fruit and you squeeze it. You got the biodiesel or pure palm oil, and it's very good for transportation. In fact, China is going to test to fly a plane. They just signed an agreement with Boeing. They're going to fly that on their planes, basically this year or next year for international flight. And that one is really, you grow in the non-fertile lands where you can grow food. So that's good food. So that's where the arena that's really, I think we think it's very interesting to look at. Although the problem, again, I said again, you can't grow in Canada. That's what makes it sort of hiding somewhere at the moment. So, like if you want to learn more about that, you can go to our website, greentech.com.
Well, we see that with all renewable energy. It comes down to what resource you have in that particular region. Solar doesn't make sense everywhere. Wind doesn't make sense everywhere.
Yeah, you have,
biofuel resources vary from region to region.
Basically, the drop-in kind of things, like where you can't really, at the moment, it's not feasible to have a solar plant. Although somebody flew it commercially, right? Then you got your ship, like all your cargo transportation. In fact, we're talking to airport AP Moller MaRS. They're interested to offtake the things when you have enough commercial things for their green ship, they call it, where they actually run on the diesel or biodiesel, that kind of thing. So that's really, that will sort of one wedge into the renewable sort of energy stuff, because really, like you have to look at all these sectors. Even if for battery, I'm a geologist, like when you do a lot of batteries, right, you have to remember you have to mine them. Then again, to mine them you need energy again, all sort of things. So it's basically, just different sector, different wedges into it.
I'd like you to join me in thanking Rupert and Tim today.